Hello everyone, I'm Noah Lui, RHB Bank's Head of Investors Advisory. I'm honored to have together with us today Thierry Taglione from Alliance Bernstein. Thierry is a Managing Director and Head of Fixed Income Business for Alliance Bernstein in Asia. He is the member of Alliance Bernstein Global Fixed Income team that manages over US 260 billion in fixed income assets for clients around the world. Thierry has been based in Hong Kong since 2011. Welcome to our show, Thierry, and glad to have you together with us today.
Thanks for having me.
A lot has happened since the start of the year with the continued US Fed rate hikes combined with the stress in the banking sector and now a debt ceiling debate. For a start, where do you see the economic outlook for the rest of 2023?
Sure. We started the year 2023 with the view that this year is a year of transition. Transition not without disruption. In terms of economic growth, we expect a slowdown, a mild recession in the US and in Europe. We expect inflation to decelerate this year. It's already started when you look at goods inflation, housing market, but it remains still very sticky, especially in the services sector, and well above the central bank's targets. In terms of rates, we expect central banks to move into a pause this year after very unprecedented rate hikes last year. And lastly, when I look at corporate credit and corporate bond fundamentals, we see a lot of very strong companies entering this year, both in high yield as well as investment grade corporate debt.
That's great, Thierry. Thank you for sharing the overall macro outlook for the rest of the year. Just for the month of May itself, another 25 basis point of rate hike from US Fed, combined with the fear of the US hitting its debt ceiling. Is there a chance for US Treasury to go default or maybe to be downgraded? According to Fitch, US Treasury is still rated AAA.
So let's start with the Fed's policy. So we just had a 25 basis points hike in May, and we believe that's going to be the last one for the year. We expect the Fed to pause its rate hiking cycle, and really what you see here is the tug of war between very high inflation, well above the 2% Fed target, and the banking crisis. So it's a very difficult environment for the Fed really to become more accommodative and eventually cut interest rates. We don't believe they will cut interest rates until the end of this year. With regard to the debt ceiling debate, there are a lot of discussions around this. Our view is that we're going to see a similar playbook than what we saw in 2011, with an agreement between both parties being reached potentially at the very last minute, and really avoid a potential default of US treasuries, which obviously would be a very dramatic event in financial markets. So $31.4 trillion of debt, that's the ceiling. We're close to that limit. Interestingly, since 1960, the Congress actually revised up or extended its debt ceiling either permanently or temporarily 78 times. So that gives us a lot of comfort that an agreement will be found and then we will avoid a US default.
Thanks for sharing, Thierry. I didn't notice that the debt ceiling limit has been reached so many times over the past few years. For the year, for the first quarter for the year, the market has done relatively well. But when it comes to the month of March, the news of the Silicon Valley Bank collapse has materially dampened investor sentiment. Can you share with our investor what has triggered the fall of SVB? Global investors, example like Warren Buffett, said that we are not over with the bank failure. Is there any way to prevent the potential global contagion?
So banking is all about confidence, right? So in the case of Silicon Valley Bank, back in March, if you recall, Silicon Valley Bank or SVB is a very niche bank. So their core business is to provide financial services to tech companies that have exposure to life sciences, venture capital. It's a very specific segment of the economy. And basically what happened is SVB was holding a lot of high quality treasuries on their balance sheet, but got caught with the rapid hiking cycle from the Fed. And then the valuations, the mark-to-market valuations of those treasuries went down. In the meantime, those tech companies, venture capital companies, couldn't really raise debt or equities. They couldn't really have IPOs, so their funding costs actually increased, and they needed to withdraw cash from the bank, from SVB. So there was clearly a mismatch between assets and liabilities leading to this crisis. And then, so SVB had to sell $21 billion of US treasuries and made a loss of close to 1.8 billion, right? So clearly there was a loss of confidence, and that led to a bank run. Importantly, we see this as a duration crisis, sensitivity to interest rates going up, rather than a credit quality crisis, because SVB held very high quality treasuries on their balance sheet.
Still on the bank failure or financial crisis, comparing to year 2008, US equity market dropped almost 50% from its peak to its bottom. How different is it from what we are seeing now in 2023 comparing to 2008 financial crisis?
So 2008 was really a credit crisis, right? So it was led by very bad loans. Remember, we had subprime debt, basically mortgages from low-income families unable to repay their mortgages, and these mortgages were packaged into very complex financial products. So the crisis went from a mortgage crisis with subprime debt, and then went into Wall Street with those financial instruments, and eventually became a global financial crisis. So in the situation we had in March, this banking episode, I don't even call that a crisis. This is not a crisis led by bad loans, bad quality assets. It's a crisis led by duration risk, sensitivity to interest rates. If you look back at what the Fed has been doing, they've been hiking about 10 times over the past 12 months or so also. So that's unprecedented. So obviously when the Fed hikes a lot and other central banks follow in order to fight inflation, you are going to see segments of the economy breaking. So we had tech crisis, we had some crypto crisis, a banking episode. So clearly this is the new norm, and we expect more disruptions going forward.
Yeah, Minister, it's a very good opportunity that we have Thierry with us today. If you have any questions about the global financial crisis or any recent macroeconomic announcement, do put down your comment in the comment box below. We will try to address your questions as soon as possible. Thierry, the elephant in the room, Credit Suisse AT1 bond write-off, has recently caused fear in the global fixed income market. Despite bond has been relatively given the higher priority against the common shares holder, however, that is not the case for the Credit Suisse AT1 bond. Given this unique situation, can you share with our investor what has happened?
Sure. So Credit Suisse has had issues for a number of years, right? So most investors believe in management being able to come up with a restructuring plan in order to address those issues. Unfortunately, as I mentioned earlier, banking is all about confidence. So Credit Suisse was the softest target within the banking sector in Europe. And basically over the space of, let's say, a few days, UBS was able to take over Credit Suisse. So that led to a lot of volatility in the market, but we believe the Credit Suisse event is very idiosyncratic. It's very specific to the Swiss financial sector. And what happened really is that the so-called additional tier 1 bonds, which sit typically above equity in terms of seniority and below senior debt, these products or these bonds are usually used as a total loss absorption capacity. Remember, after the global financial crisis, a lot of banks have been able to strengthen their balance sheets. In fact, if you look at their capital ratios, they've been going up significantly. So the fundamentals of the banks have been much stronger. Unfortunately, within the space of a few days, in order to facilitate the UBS takeover and stop this contagion with massive outflows, billions of outflows from Credit Suisse, the Swiss regulator came up with a new law over the weekend, really allowing shareholders of Credit Suisse to keep some value, about 3 billion, but in the meantime, wiping out $17 billion of debt for the additional tier one bond holders. That's unprecedented. That's very unique to this case. And unfortunately, that took the market by surprise. That's led to extreme volatility in the AT1 market. But since then, we've seen a recovery in both subordinated debt, so AT1s, but also senior debt was pretty much left immune. And in fact, for us, we believe that was a great buying opportunity. Again, the focus for our funds, our strategies here is about global, systemically important banks. So large national champions in the US, in Europe, and Asia. So that's very much a buying opportunity for us that we had back in March.
Thank you for sharing, Thierry. Clearly that the scenario or situation for Credit Suisse 81 bond is unprecedented. So for investors, can we understand for yourself as an expert in the global fixed income market, how would you maximize income from this current interest rate environment?
So clearly bonds are back, right? So you have plenty of income opportunities this year. No need to stretch for yield anymore. So we see value across the entire fixed income spectrum, going from high quality treasuries to investment grade bonds into high yield. So our approach at AB is to adopt a so-called global multi-sector approach, right? So investing in multiple sectors in order to generate income. And we adopt a balanced approach, or barbell, which is going to combine risk mitigating assets such as treasuries, high quality AAA rated bonds, with return seeking assets such as high yield, investment grade corporate bonds, emerging market debt. So combining these two types of assets is going to deliver a very attractive income. So income is a priority for our strategy, using multiple sectors in order to deliver the highest possible payout to our investors. And lastly, so balanced income diversification is key. In some of our large global portfolios, we have over 1,000 holdings, right? So even if you have some stress in some of the names, some of the sectors, you should expect a very diversified portfolio to outperform throughout the cycle.
A lot of our investors view that investing into fixed income market are relatively boring. So with the current interest rate environment, what type of total return that our investors can expect if given a 3 years time horizon? Is there any particular region or sector that investors should look into?
Sure. So number one, trying to time the market is always a very challenging game, right? It's not a game, but it's very important for investors to stay the course, stay invested, and not try to time the bottom or the top, really. So we like to say that time in the market is always more rewarding than trying to time the market, number one. Number two, in terms of where we see opportunities, as I mentioned, we like a global multi-sector approach that will source income from multiple segments of the bond market, whether it's government bonds, corporate high yield, investment grade corporate bonds, a little bit of emerging market debt, and to a certain extent, a little bit of securitized debt at the margin, right? So really adopting a global multi-sector approach is key. In terms of expected return, if I look at one of our large global multi-sector strategy, the level of yield towards in the portfolio for a very high quality portfolio, A- rated, is over 7%. And typically, the yield to worst is a very good predictor of forward-looking returns for the next 3 years. So if you start at a yield of 7% or more, you can expect that over the next 2-3 years, a total return of 7% is achievable as the Fed closes its interest rate cycle and eventually pivot. The pivot of the Fed can also add a bit of a kicker to the total return. We call that the duration tailwind. And also don't forget that a lot of the bonds are not trading at 100 at par. If they are trading at, let's say, 90 cents to the dollar, there's a lot of pool to par opportunity to add a bit of capital appreciation or capital growth. So 7% plus type return per annum over the next 3 years to us is a very attractive proposition. Again, starting from a global portfolio, very diversified and a very high quality portfolio at A- average rate.
Okay, I hear a few keywords. You did mention active management. You also mentioned that investing into a multi-sector portfolio, and of course, a well-diversified portfolio has been some of the keywords. And I also hear you mention that given the 3-year time horizon, on the per annum basis, a potential return solely based on yield could give about 7%. And just to add on, there could be also chance for capital gain. That sounds like a very reasonable return for a fixed income portfolio. This is my last question, Thierry. Personally, for the rest of 2023, where do you put your own money between equity and fixed income, and why?
So bonds are back. So I will be overweight fixed income this year. Like I said, yields are very attractive. If we enter a slowdown later this year, I think owning longer duration assets is going to be rewarding. So I would I would allocate to a global, diversified, multi-sector portfolio. That's number one. I do see value in short-dated high-yield bonds. I like high yield as a substitute to equity risk, right? So if we see an economic slowdown, obviously some stocks, especially growth stocks, should be expected to underperform. So high yield could be a great alternative to stocks. Don't forget that high yield is seeing companies that are very strong in terms of fundamentals. A lot of defaults already happened during COVID, like 2-3 years ago. So these companies had time to strengthen their balance sheet and really come in with very high interest coverage as well as very strong fundamentals. So we like selectively high yield, especially non-cyclical sectors. If we move into a recession, of course, you want to invest in non-cyclical sectors, less exposed to a slowdown. And then lastly, in terms of region, like I said, I like a global portfolio, but I'm quite constructive on Asia. India and China are very big economies. In fact, this year, India and China are going to contribute more than 50% of the global growth, looking at GDP numbers, according to the IMF, right? So there's a lot of good stories, especially domestically driven economies within Asia. Again, being selective is key, and we like more value stocks than a portion of our portfolio and my portfolio as well.
Okay, that's refreshing to hear from you. Like I mentioned just now, a lot of our investors are heavy big into equity, but you do share that there are some investment strategy, example like investing into high yield bond that could be a substitute for the equity risk. If I could add on, other fixed income instrument also includes like convertible bond would potentially have the similar effect. It's good also that I hear that you are constructive on the domestically driven Asian economies like the China and India market. Thank you very much for joining our Money Chat today. We notice a lot of our investors are heavily weighted in equity funds. There are very low awareness of investing into fixed income. So there are some ideas that you can consider for your investment portfolio. Do contact our RHB relationship manager to know more about these funds. See you again in the next Money Chat series.